This video is about constructing a cash flow statement for Level 3 accounting at NCEA. There's going to be 3 different videos, one for cash from operations, one for cash from investing activities, and one from cash from financing activities. When you do a cash flow question, you'll get a number of bits of resource material which you'll need in order to construct the cash flow. You're going to get given this year's income statements. This is my statement of comprehensive income here, and some of the notes that go with that income statement. In this case, I've got an other income and a finance cost note. And you're also going to get given a statement of financial position. Now, for the statement of financial position, you're going to need 2 years of data. So in this case, I've got 2019 data and 2020 data. Now, alongside this, we will also get some notes to go with that. So in this case, I've got an accounts receivable note, I've got my PPE note here, and there's usually some sort of additional information at the bottom that's going to give you some hints of what things you need to look for on the way. Now, cash flow statement is a bit like a giant jigsaw puzzle with some problem solving involved. So on this spreadsheet, I've got what we need for our cash from operating activities. Now, cash from operating activities is all the cash flows to do with operating the business. Now, the statement that's about operating the business is our income statement. So we're going to be looking at all the cash flows that are on our income statement here. When we do a statement of cash flows, and I've got here the first section, these are the things that we're going to be looking for. So first of all, we're going to hit up cash from operating activities. And under each of the 3 sections, we're going to have cash was provided from and cash was applied to. So these here are our sources of cash, and these are our uses of cash. There's always going to be cash from customers. So that is no matter whether you are selling a good or a service or you're a manufacturing firm, there's always going to be cash from customers. Then quite often we have an additional source of cash. In this case of this business, they also earn cash by renting out part of their buildings. So we're going to be calculating what they've got from rent as well. Under the cash was applied to, or the outflows of cash, there's usually cash paid to suppliers. So if we are a trading firm or a manufacturing firm, we're going to be buying in either inventory, raw materials, those sorts of things. So how much have we paid our suppliers for those? We're also going to have our cash paid for other expenses, so our sort of general catch-all expense category. We have interest. We're required to disclose interest separately. So interest is going to be a separate line here. And last of all, there's going to be tax. So how much tax have we paid to the government? We're going to start off with our cash from customers. Now, for cash from customers, I'm going to use this tool here. I'm going to reconstruct the accounts receivable ledger account. Now, to do that, I'm going to look at my statement of financial position, and I'm going to look at my current assets. And for this, I'm going to need my opening and my closing balance of accounts receivable. As you can, now this is the trick with accounts receivable though, is you've always got to check whether there's a note to go with it. And for this business, I do have a note. And a note will tell us what allowance for doubtful debts there has. So for example, in 2019, accounts receivable was 65, allowance for doubtful debts was 5, and so forth. That's the 60 that gets put up from there. But we need to track this back and actually get the true opening balance of accounts receivable. In this case, it's 65. So there's my 65 opening balance there. My closing balance is 75. So I'm going to put my closing balance down the bottom. Then I've got to go, what's going to make my accounts receivable go up? Well, that's going to be my main form of revenue. Okay, this revenue one is always only one item, and that will generally be sales or fees. So it's going to go here. For this business, I'm going to call it sales. And that's going to be 1,800. That brings me to a balance of 1,865. And debit. Then I've got to look for anything that's going to make my accounts receivable go down. Now, there may be something there might not. But having a look through here, the sorts of things we're looking for are bad debts and discount allowed. In this case, I have bad debts. So that reduces the amount of cash that I'm going to receive from my customers. So my bad debts of 10 is going to take that down to 18.95. But that's the only one I've got. I don't have a discount allowed there. Now, from bad debts, right. So now we need to work out how much cash we've received. We know it was 18.55 we could possibly receive. We still had 75 we hadn't received. So how much had we received? And that'll calculate out to be 17.80. So this, the figure here, the 17.80, that's what's going to go down here in my cash from customers. The next thing we're going to look at is rent. So that's going to be found. We need to look at our other income note, and we need to have a look to see what's under there. Now I've got two items, got rent and increase in fair value of financial assets. Now the increase in fair value of financial assets is a non-cash item. There's actually no cash flow associated with that. And as is this a cash flow statement, we don't put that in there. However, we did earn $144,000 worth of rent from renting out part of our buildings. The next thing to have is have a check of your current assets and current liabilities section to see if there's any balance day adjustments to go with that. Okay, so they're either going to be income in advance or income accrued. Now there's no income accrued under current assets, but if we look down under current liabilities, we see income in advance there, rent. Now, there's a number of ways to do that. You can reconstruct ledger accounts. This is the one that I use for my class, and we call it a little mnemonic, and the mnemonic is add a buy, B-A-I, add a buy. So I'm going to put my rent in here, which is 144. Now, that mnemonic stands for add beginning accrued income. So if there's any accrued income, we're going to add it to the beginning. Now, from this mnemonic, we can work out what we do with the other balance day adjustment accounts. And the rule is everything is an opposite. So if we're adding beginning accrued income, the other balance day adjustment is income in advance. So we've got to add end income in advance. Now, there's no accrued income, so that's going to be 0. My end income in advance, I look down here, is going to be 8. Going down further, if I'm going to add beginning accrued income, that means I less end accrued income because end is the opposite to beginning. So my end accrued income, once again, is 0 because I don't have it. And if I'm going to add end income in advance, I must less beginning income in advance. And my beginning income in advance was 12. I put things in brackets in my spreadsheet, it turns into a nice little negative there. So I've got 144. I'm going to add my 8. I'm going to minus my 12. And that's going to give me 140. So over here, I'm going to put 140. So I've now got all my cash flows inwards cash flows. Now I'm going to do my outwards. My outflows are cash. First one I'm going to do is pay to suppliers. Now cash paid to suppliers, we need two tools. I'm going to reconstruct my inventory ledger and my accounts payable ledger. Once again, I'm going to need opening and closing balances. So my opening balance of inventory was 68 and my closing balance was 74. They're both assets, so they've got debit opening balances. My opening balance for accounts payable was 52 and my closing balance was 60. That's a liability, so it's going to be a credit opening balance. What's going to make inventory go up? It's going to be purchases of inventory. What's going to make it go down? It's going to be sales of inventory with it. Now, I don't have any purchase information, but I do up here have how much worth of inventory I've sold this year. So that's my cost of sales, which may also be cost of goods sold, same thing. And that's 760. So I'm going to put in here my cost of sales. Selling inventory makes inventory go down. So That's going to be, and I said it was 6, cost of sales is 760. Now notice that's making inventory go down, so I'm putting it as a credit because inventory goes down. And that also means now my running balance is going to be 692, and I've gone over into credit territory just temporarily with it. So remember what I said about what makes it go up? Well, that's going to be purchases, and that's the missing figure I'm trying to work out. So that's going to be what goes in here to make it balance. And in this case, it's going to be 766. Because we've gone from a 692 credit to a 74 debit. So altogether we need a 766 debit to get there. Now this figure here, we're then going to transfer down into here. Okay. So accounts payable, our purchases are going to increase the amount we owe. So therefore it's going to be a credit there because we owe more money or more cash when we purchase our inventory. That's going to give us a balance of 718 credit. So therefore, if our closing balance is 60, how much have we actually paid our accounts payable? And that's going to be 758. That number there is then going to go down in here. Next one I'm going to do is expenses. So for expenses, we need to start off by getting our cash expenses, not including interest. So looking up here at our income statement, we've already used cost of sales, so we don't use that. General expenses, that's going to be cash expenses there. We look at bad debts, depreciation, doubtful debts, and loss on sale. They're all non-cash expenses, so we don't include those. We're only using the cash expenses here of the 686. So I'm going to do the same process. Instead of add a by, I've now got add a bay, add beginning accrued expenses. So I go up here, I have a look to see if there's any balance day adjustments. Now I've got both accrued expenses and I've got prepayments. And they've made it really clear here that the accrued expenses are to do with general. Sometimes you might find them might have interest written beside them, so you know that they're to do with interest and not the general, so you don't use them when you're working out the cash paid for the general expenses. In this case, they have. So I need beginning accrued expenses, which is 2. I'm then going to add, since I added beginning accrued expenses, I then add end prepayments. So end prepayments is 7. And since I added beginning accrued expenses, I'm going to less end accrued expenses because that's the opposite there. So end accrued expenses is 14. And once again, add end prepayments, so therefore less beginning prepayments, being the opposite. Beginning prepayments were 12. So then we just do the maths, we go 686, we add the 2 and add the 7, and then minus the 14 and minus the 12, and that's going to give us 669. And that's how much we've actually paid out in cash for our expenses. Next one, we're looking at interest. Like I said before, you need to check the balance day adjustments. We've already used all the balance day adjustments, so we know there's none to do with interest. But if the accrued expenses says interest, then you just do add a bay, starting off interest, add your beginning accrued expenses, prepayments are going to be 0, less your end accrued expenses, prepayments 0, to get your actual interest paid. This case here isn't, so it's just as it is our finance costs of 14. So there's our interest on loan there of 14. And then the last one is tax. The tax, we need to check over at our current liabilities to have a look to see if we owe any tax. We do. We've got a tax payable account here. The opening balance was 14 and the closing balance was 4. So we're going to once again use our ledger accounts to reconstruct this. Our tax expense for the year was 98. So we owe that 98 to the government. So that's why it goes in the credit column, because we're owing that to the government. So 14 and 98 is 112. So how much must we have actually paid for the government to end up with only owing 4? We must have paid 108. And that's the number that ends up going over here. So there's our cash from operating activities section completed for our cash flow statement. Look at the next video to find out what to do for investing.